If you have been around markets long enough, you learn that the most dangerous moments are not the ones that look frightening. The most dangerous moments are the ones that look contradictory. A war breaks out. Oil routes are threatened. Missiles are flying. Every instinct says gold should rise, then gold falls anyway. Not a little. Hard enough to make intelligent people doubt what they thought they understood about money, safety, and the purpose of owning an asset that no government can print. That is where most people make their mistake. They assume the market is speaking clearly, when in fact the market is speaking in layers. One layer is saying one thing. Another layer is saying something else. If you do not know which layer is driving the price, you can mistake a forced sale for a change in long-term value. You can mistake a margin call for a verdict. I have spent most of my life trying to separate those two things. When I buy a business, I do not ask whether the crowd is cheerful today. I ask what the asset is worth, what pressures the owner is under, and whether the price on the screen is the product of reason or the product of compulsion. That same habit matters in the gold market, especially in a moment like this. So, let me say the uncomfortable thing first. A falling gold price during a war does not automatically mean gold has failed as protection. It can mean the exact opposite. It can mean the financial system is so stressed that institutions, and even governments are selling the one thing they would rather keep because they need dollars immediately. That is not a thesis. That is a mechanism. And when you understand the mechanism, the entire episode looks different. Most men and women are taught a childlike version of markets. They are told that gold is a safe haven, therefore war should make gold rise. That is neat. It fits on a television banner. It also leaves out the part that matters. Gold is not priced in a vacuum. Gold is priced inside a monetary system dominated by oil, interest rates, currency pegs, collateral chains, leverage, and computers that do not care about history, common sense, or the emotions of the person watching the chart. When those forces move together, the first move in price is not always the truthful move. It is often the forced move. That is the mother line I want you to carry all the way through this conversation. The first thing I want to name is what I call the dollar scream. When people hear about a war in the Middle East, they picture tanks, maps, speeches, and headlines. They do not picture cash plumbing. They do not picture invoices. They do not picture a finance minister waking up and realizing that his country needs dollars now. Not in 3 months, not after the next bond issue, not after sentiment improves, now, but that is where the story begins. A conflict that disrupts oil transport does not merely create fear. It creates a dollar shortage for countries that need energy and for countries whose currencies are stabilized against the dollar. When oil spikes, the bill rises instantly. When shipping lanes are blocked or threatened, revenue falls or timing breaks down. If your country imports most of its energy, you need more dollars to pay for the same survival. If your country exports energy but cannot move enough of it, the dollars you were counting on do not arrive on time. Either way, the same scream begins, dollars, dollars, dollars. That demand can overpower almost every other short-term story in the market. People do not understand how violent that can be because they think in narratives, not in balance sheets. Imagine a nation with a fixed relationship to the dollar. Its credibility depends on defending that system. Imported food still has to be bought. Fuel still has to be paid for. Machinery, medical supplies, military inputs, all of it still has to clear. The population will tolerate many things. A collapsing currency is rarely one of them. A government can survive embarrassment. It struggles to survive a currency panic. So the central bank looks at its options. Let the currency fall and invite inflation, instability, and political danger. Burn through dollar reserves that were already finite before the crisis, or sell an asset that can be turned into dollars quickly. That asset is often gold. This is why a sovereign can behave exactly like an over-leveraged trader. It is the same economic humiliation in a more expensive suit. The phone does not ring from a broker. The pressure comes from oil invoices, the currency market, capital flight, and the need to defend a system before confidence slips. If you own gold and you do not understand that, you will think a gold drop during war is irrational. It is not irrational. It is a margin call with a flag on it. Now, in the version of the world most investors carry in their heads, governments hold gold because they love it in the abstract. That is not how the world works. Governments hold gold because there are moments when trust in promises weakens, and gold sits outside those promises. Gold cannot be printed. It cannot be frozen by the same political mechanism that freezes a bank balance held inside someone else's system. It has no counterparty risk. Those qualities do not disappear because a central bank is forced to sell some of it to get through a crisis. In fact, that is when those qualities become the most obvious. A man pawns his watch because he is under pressure. That does not mean the watch stopped being valuable. It means he ran out of easier things to sell. That is how I want you to think about forced sovereign gold selling. The second mechanism is what I call the rate hammer war. Driven oil shocks do not just produce fear, they also embed inflation into the system. Energy is not a small corner of the economy. Energy leaks into transport, fertilizer, food, plastics, manufacturing, logistics, and psychology. When energy rises sharply, inflation does not remain a theory. It gets into daily life. That matters because the market then has to recalculate the path of interest rates. If investors had spent months convincing themselves that central banks were about to cut rates and rescue risk assets, an oil shock can destroy that comfortable story very quickly. The market begins repricing, rate cuts disappear, hikes, or the possibility of hikes, come back into view. Bond yields move higher, the dollar strengthens, because now cash parked in dollar assets looks more attractive relative to weaker currencies and more fragile systems. That is where gold gets hit the second time. A stronger dollar and higher real yields are a headwind for gold in the short run because capital can earn a visible return in government paper. Money does not ask moral questions. It asks where the combination of safety, liquidity, and return looks best this week. If a 10-year treasury yields enough, some money leaves gold for that reason alone. Now, that does not mean the long-term case for gold has been broken. It means the time horizon on the screen has shortened. The crowd stops asking what kind of monetary world they will live in 5 years from now and starts asking what pays them immediately and what gets them through the quarter. That shift in horizon is one of the oldest reasons markets become foolish. I have watched this happen in stocks many times. A business with magnificent economics can fall sharply because the market is suddenly obsessed with the next 2 quarters. The economics did not disappear. Attention span did. Gold behaves the same way during a shock like this. Its strategic value can remain intact while it's near. Term price gets hammered by the rate hammer. The third mechanism is what I call the machine avalanche. This is where a great many ordinary investors get hurt without understanding why. They still imagine markets as gatherings of people making thoughtful decisions. A war begins, a commentator speaks, a portfolio manager decides. That world still exists in fragments. But an enormous part of what moves price now is rule-based, mechanical, and indifferent. Algorithms do not love gold. They do not fear war. They do not ask whether a central bank is selling voluntarily or under duress. They process inputs, dollar up, yields up, risk regime changed, sell, trend broken, sell, support failed, sell more, then volume triggers more systems, then volatility triggers more systems, then stops trigger more systems. By the time the human being at home opens his app and sees the red on the screen, an entire machine ecosystem may already have dumped billions of paper exposure. This is important because many investors interpret speed as truth. That is a terrible habit. Price can move quickly for reasons that have nothing to do with settled value. Price can move quickly because a rule was hit, a level broke, a program reacted, and another program reacted to that reaction. If you mistake that for deep judgment, you will hand your capital to people who understand the machinery better. The fourth mechanism is what I call the leverage death spiral. The ordinary investor is invited into markets through stories of easy multiplication. 2 times this, 3 times that. A little leverage looks harmless when the thing you own keeps rising. In a strong market, it feels almost intelligent. It feels efficient. It feels like the timid person's version of boldness. Then the direction changes. Most people never learn the design of the instrument they bought. They know what it promises in a good week. They do not know what it is forced to do in a bad one. A leveraged metals product that resets daily is not a simple amplifier of a long-term thesis. It is a machine that can require selling into weakness as it rebalances, especially when price swings violently. Add in margin calls on top of that, and you have a structure where lower prices create more selling, and more selling creates lower prices. That is not investing. That is fuel on a fire. When retail investors pile into leveraged exposure late in a move, they become willing donors to the next downdraft. They help push the rally higher on the way up. Then, when the structure turns, the same products become wrecking balls on the way down. This is one of the reasons I have spent a lifetime warning against cleverness that depends on perfect conditions. I do not like structures that demand my cooperation from the market. If your instrument needs stability, steady trends, and your own flawless emotional control, you do not own an investment. You own a test you are unlikely to pass under pressure. The fifth mechanism is what I call the sovereign pawnshop. This is where the episode becomes especially interesting to me. A great many countries spent the past several years buying gold with seriousness because they no longer wanted all of their reserves tied to a system that could be weaponized, frozen, or politically redirected. Once a government sees that reserves inside another nation's framework can be made inaccessible, the romance of pure paper neutrality starts to fade. Gold begins to look different. That strategic logic does not disappear because a crisis interrupts it. But if the same countries then face a war shock, a currency defense problem, a revenue gap, or rising military costs, they can be forced to monetize the very reserve asset they were building for protection. Sell a little, swap some, raise dollars, stabilize the home front, buy time. That is why I call it a pawn shop. The person in the pawn shop does not hate the necklace. He hates the deadline. Now, once you see it that way, you stop thinking in cartoons. You stop saying, if gold is good, why is gold down? You begin asking the adult question instead. Who has to raise dollars right now? Who is defending a peg? Who lost a revenue stream? Who is funding a war? Who cannot tolerate a currency break? That is the line of inquiry that matters. In my world, the right question usually matters more than the right answer. The sixth mechanism is the historical echo. I learned a long time ago that when the world presents you with a surprise, you should ask whether it is really a surprise or merely an old pattern wearing modern clothes. Gold has seen violent drops before that had less to do with the death of its long-term role and more to do with funding stress, reserve pressure, and oil-linked monetary distortions. The dates change, the cast changes, the mechanics remain embarrassingly familiar. That is one reason I never let a dramatic week convince me that history has been abolished. In finance, history is rarely abolished. It is simply renamed by younger people when an oil-producing or oil-dependent region is under stress, when currencies must be defended, when debt and liquidity matter more than elegance. Gold can be sold because it is useful, not because it is worthless. That distinction sounds small. It is enormous. A weak business is sold because nobody wants it. A strong reserve asset can also be sold because everybody knows someone will take it. Those are two different acts. The seventh mechanism is the paper-physical split. This is where patience earns its keep. The gold price most people stare at is largely a paper expression. Futures, options, funds, derivatives, synthetic exposure, trading programs, collateral chains. That paper world can move violently and can be bullied by short-term necessity. The physical world is different. Physical gold is not a blinking quote. It is metal that changes hands, leaves vaults, moves between jurisdictions, gets accumulated by buyers who care far less about the next week than about the next decade. When paper price falls at the same time, physical demand remains firm or even strengthens. The market is telling you two stories at once. One story says the leveraged and the hurried are being cleaned out. The other says the patient are shopping. Now, I want to be careful here. A paper physical split does not guarantee an immediate rebound. It does not mean next Tuesday will be wonderful. It does not mean pain is over. Markets can remain under pressure far longer than people who recently discovered conviction would like. But it does tell you something important about the nature of the move. If paper is collapsing because machines, leverage, and forced sellers are dumping exposure while physical buyers quietly absorb at lower prices, you are not watching a simple rejection of gold. You are watching ownership migrate from weak hands to strong hands. That process is almost never pleasant to observe while it is happening. It is, however, one of the most important processes in all markets. The crowd likes stories about upside. Fortunes are often built in transfer. At this point, if you are honest, you should begin to feel a shift in your identity as an investor. Before this point, many people approach gold like tourists. They want it to validate them quickly. They want headlines, applause, smooth charts, and evidence that their idea was right immediately. They do not really want an asset outside the system. They want the feeling of being clever inside the system. That attitude will get you hurt. The identity flip comes when you stop asking whether the market is rewarding your mettle today and start asking what role the asset plays in a world where debt, energy shocks, reserve weaponization, rate volatility, and forced selling are all real. That is a different frame. You are no longer a spectator of the chart. You are a steward of purchasing power. You are no longer demanding that gold entertain you. You are deciding whether it belongs in a serious structure built to survive conditions the average portfolio was never designed for. Once you make that identity shift, your behavior improves. You stop using leverage to express a long-duration thesis. You stop needing immediate emotional confirmation. You stop interpreting every drop as betrayal, and you begin behaving more like an owner. Now let me tell you what I would actually do with a situation like this, because philosophy without a protocol is just a good sounding speech. My first rule is brutally simple. Never allow a long-term thesis to be expressed through an instrument that can force you out before the thesis has time to work. If you believe in gold as a store of value, reserve insurance, or protection against currency debasement, do not put that belief inside a structure built to implode under volatility. A thesis about the fragility of paper systems should not be owned through the most fragile paper wrapper available. That is not strategy. That is comedy. My second rule is that cash flow matters as much as conviction. The patient accumulator can only be patient if his daily life is not one margin call after another. If you need your gold allocation to rescue your checking account next month, you have already missized the position or misread your own life. I have seen people ruin excellent ideas because their personal balance sheet was too tight to let the idea breathe. That is true in stocks. It is true in gold. It is true in almost everything. The investment must fit the investor. My third rule is to watch the right scoreboard. In moments like this, people watch bombs and headlines. I watch the variables that actually force behavior: the dollar, long rates, liquidity stress, funding needs, signs of sovereign pressure, the difference between rumor and confirmed selling, whether physical buyers are backing away or stepping in. The plumbing is often more informative than the poetry. A man who watches the wrong scoreboard can be factually informed and financially blind. My fourth rule is to separate accumulation from prediction. I do not need to know the exact bottom to know whether an asset is becoming more attractive relative to the long-term reason for owning it. People lose fortunes trying to turn every decision into a prediction contest. They think the highest form of intelligence is calling the exact turn. It is not. In many cases, the highest form of intelligence is building a process that does not require the exact turn. If I liked an asset at a much higher price because of a structural argument, and the structural argument remains intact while forced selling pushes the price lower, I become more interested, not less. That does not mean all at once. It does not mean recklessly. It means intelligently, incrementally, with a respect for the fact that forced liquidation can last longer than the first frightened week. My fifth rule is that optionality is precious. If this reset lasts longer than the crowd expects, the investor with liquidity has a radically different emotional experience from the investor who went all in too early. The liquid investor can observe, buy in tranches, and take advantage of panic. The exhausted investor can only pray. Prayer is not an allocation strategy. My sixth rule is that no single asset should be asked to do every job. Gold is not a business. It does not reinvest capital at high rates by itself. It does not innovate. It does not market toothpaste. It does not expand margins. It serves a different purpose. It sits outside credit risk and political printability. That purpose is valuable, but it is not tenderly the purpose of a superb operating company. Confusing those roles leads to sloppy thinking. I have always preferred knowing what each piece of a portfolio is there to do. If you ask gold to behave like a growth stock, you will resent it. If you ask a growth stock to behave like disaster insurance, you will resent that too. Clarity of purpose is one of the cheapest advantages an investor can have. Now, I want to say something about the long-term case, because some people hear all of this and think the conclusion must be that gold is broken for years. That is too lazy for me. A violent decline can be the beginning of a long reset. It can also be the mid-cycle purge that removes speculative excess while leaving the strategic case untouched. The answer depends on what actually changes in the system. Has the world become less indebted? Has reserve weaponization become less relevant? Has the incentive for non-Western reserve managers to diversify away from pure dollar exposure disappeared? Has the temptation for governments to suppress rates and solve debt burdens through financial repression evaporated? Has geopolitical fragmentation reversed itself? If the answer to those questions is no, then the long-term case has not been destroyed. The market may still need time, the price may still need to suffer, weak hands may still need to leave, but the long-duration logic remains in the room. That is the distinction mature investors live on. Children ask whether the number is up or down. Adults ask what changed. One of the great advantages in life is being willing to look temporarily wrong while you wait for a structural truth to assert itself. Most people cannot do it. Their self-worth is too intertwined with the latest quote. They need to be agreed with constantly. Markets feed on that weakness. You should not. There is another angle here that I think matters deeply. Whenever a market falls violently, people assume the pain is proof of error. Sometimes it is, many times it is not. Sometimes the pain is simply the admission price to own something that others will be forced to surrender. The person with no leverage, with cash reserves, with a real-time horizon, and with a correct understanding of what he owns experiences a decline very differently from the person who bought a thrill packaged as a thesis. That difference is not luck. It is structure, and structure, more than brilliance, is what saves people in rough markets. Let me make this more concrete. Suppose you are watching gold fall in the middle of a geopolitical crisis, and your instinct is to say, "This makes no sense." That reaction is understandable. It is also incomplete. The better reaction is to ask 6 questions. First, is the move being driven by strategic sellers or forced sellers? Second, are rates and the dollar creating a short-term headwind large enough to overwhelm the safe haven story? Third, how much of the drop is being amplified by systematic and leveraged selling? Fourth, are sovereigns or quasi-sovereign entities under pressure to raise dollars? Fifth, what is happening in the physical market while paper is collapsing? And sixth, what part of the long-term case has actually changed, if any? By the time you have worked through those questions, you are a different kind of investor from the person who just stares at a candlestick and feels personally insulted. That is progress. And now I want to address the psychological trap that catches even sophisticated people. A dramatic drop invites either denial or overreaction. Denial says this cannot happen, therefore I will learn nothing. Overreaction says this happened, therefore everything I believed was false. Both responses are forms of ego protection. The correct response is more modest and much more profitable. Something happened. Why did it happen? What does it tell me about structure, behavior, and the kind of ownership I want to have going forward? That mindset keeps you in the learning seat. I have never met a person who got rich staying in the certainty seat. Now, If I were speaking to someone across the table and not to a camera, I would ask him a simple question. Why do you own gold at all? If the answer is, because I thought it would go up fast, then the recent drop is your teacher. You did not own reserve insurance. You owned a momentum trade and gave it a noble name. Because I want some portion of my wealth outside the promises of over-indebted governments and financial institutions. Then your next question is not whether the chart disappointed you this week. Your next question is whether the pressure that produced the sell-off is temporary, whether the strategic case remains, and whether your structure allows you to hold or accumulate intelligently. Two investors can own the same metal and live in entirely different realities, because their reasons for ownership are different. That is why I care so much about motive. Good motive leads to better structure. Better structure leads to better behavior. Better behavior leads to better outcomes. The market does not hand out medals for theory. It hands out, and survival, in moments like this, belongs to the investor who understands that war can hurt gold before it helps it, that dollar stress can force sales that look absurd until you study the plumbing, that leverage turns conviction into wreckage, and that physical accumulation by patient buyers can be happening at the same time the paper market looks like a fire. That investor does not need to know the exact day the turn will come. He only needs to know what game he is in. Before I finish, let me give you the blueprint as plainly as I can. Keep leverage away from long horizon metals exposure. Size the position so life cannot force you out. Maintain liquidity so lower prices are an opportunity rather than a threat. Watch the dollar and long rates more closely than you watch the loudest headline. Treat violent price breaks as invitations to investigate mechanism, not invitations to abandon thought. Distinguish paper panic from physical migration. And remember that a reserve asset being sold in a funding squeeze is not the same thing as a reserve asset losing its role. That is the blueprint, not glamorous, not exciting, not designed to impress a stranger, designed to keep you rational when the tape gets vicious. In the end, every serious market episode becomes a test of identity. Are you the sort of person who needs the crowd to agree with you in order to hold what you own? Are you the sort of person who confuses speed with truth? Are you the sort of person who buys insurance only when the sky is clear and cancels it when the storm arrives? Or are you the sort of person who understands that the world reveals its real structure, precisely when prices behave in ways that offend simple stories? That is the final test. A falling gold price during war feels offensive to the simple story. Good. That is often where the best lessons begin. The question is not whether gold had a brutal week. It did. The question is whether you now understand why. And if you do, then the next move you make will come from a deeper place than fear, from a clearer place than headlines, and from a stronger place than the leveraged crowd that always arrives late and leaves broke. I have no interest in sounding dramatic for its own sake. I am interested in helping you see the market as it is. A war can make gold fall. An oil shock can strengthen the dollar before it weakens faith in paper. A central bank can sell gold because gold is valuable, not because it is useless. A machine can dump exposure without understanding a single word of history, and a patient investor can use a phase of forced liquidation to improve his position if he has the right motive, the right structure, and the right temperament. That is how I would think about it. Not as a contradiction, as a revelation. It reveals who needed cash. It reveals who was leveraged. It reveals who owned paper and who wanted metal. It reveals who was trading a story and who was preparing for a world. And once the revelation is complete, the market usually becomes far more generous to the people who were willing to learn from it than to the people who only complained about it. That is true in gold. It is true in stocks. It is true in life. The biggest money is rarely made by the person who demands immediate emotional comfort. It is made by the person who can look at a forced sale, recognize it for what it is, and remain sane long enough to act like an owner. That is the choice in front of you now. Not whether the last week felt painful, whether you will let that pain educate you or merely frighten you. And on that question, your future outcome will depend far more on your character than on the latest quote on the screen.